Well, welcome everyone to another exciting class. This is going to be a how to buy a home, why home ownership just got easier as a home buying seminar. My goal here is to present to you guys as realtors what a home buying seminar could look like on Zoom. And then if this is of great benefit to you, then you can start to invite one or two, six, however many people you want, and we'll hold a home buying seminar. And obviously, you and your people can be on at the same time. They can be learning about how to buy a home for as little as 1%. So it's all about your journey toward home ownership, how it got easier. It's amazing to me as I talk to people, how many people don't know about the IHDA program and how it can help them become homeowners and either stop renting, or how if they're, see, some people with a little bit of the unrest that's going on in the downtown Chicago area, people are moving out of the downtown area. They're moving out to the suburbs. Some of them are selling, but they're not coming out with enough equity for a down payment on a house. And this program is also going to help them to become homeowners or to continue to stay homeowners. So with that intro, let's get into the subject matter. You guys know a little bit about me. I'm the business development manager at the Marino team at First Centennial. I specialize in getting people into home ownership using down payment assistance. I use education to help people understand how they can become homeowners and own a part of the American dream. I'm married to my college sweetheart for 27 years, and I have 3 beautiful daughters. 2 of the 3 have already bought homes using this down payment assistance program. So at least something is sinking into their heads about what I teach and what I talk about. Well, who is this class good for? Well, again, I look at from the eyes of the prism of a realtor, and I say, how many of you know renters? Well, I got to believe that somewhere in your sphere of influence, there's people that you know that are renters. Who's a leasing agent? Well, many of you have come up through the ranks, first becoming a leasing agent and then became a full broker. But again, you still do leasing activity. So again, this is going to be a wonderful class for, well, if somebody's looking at a rental, should I also be advising them? Should I also be educating them on how they could actually buy a home for less than their first month's rent and security deposit? And then again, who knows sons or daughters of past clients? Again, past clients may be in homes already, great. But just like me, it's my 2 daughters who have most recently bought using this program. So we all know a lot of friends. They all have sons, they all have daughters. This would be applicable. You would have a great audience to talk to as far as your friends that you socialize with on the weekends, and letting them know that, hey, your son, your daughter might be in a great position to become a homeowner. Let me tell you how. Who knows millennials? Again, a lot of them, my youngest daughter being a millennial, she, I don't know, Dad, about, settling down. But then she got to the point where she said, you know what, Dad, I don't want to continue to throw away. Rent is getting more and more expensive. I don't want to throw my money away on rent. I want to own something. Who knows people that think they can't buy a home because they don't have enough money saved up? Well, there's a lot of people I know that they self-defeat themselves. They say, well, I don't have the down payment, I don't have closing costs, therefore just show me a rental. I can't buy at this point in time. So again, these are some of the people that that you're going to meet, and that this would be a great class for. And by the way, I will be giving out this PowerPoint presentation to everybody who's in attendance today. Why would you want to buy a home? Well, maybe you want to stop paying rent to a landlord, just like my daughter did. She said, rents are getting more expensive. Maybe they want to move out of a parent's home, or maybe I should put it the other way. Maybe the parent wants them to move out of the home. But yeah, moving out of a parent's home. Gaining independence, which goes hand in hand with moving out of the parent's home. You want to have your own space, your own place. You want to pay less in income taxes. You've graduated from school, or you've just gotten a new job, a promotion, and you're paying more in income taxes. Well, maybe you want to deduct the interest expense. Maybe you want to deduct the real estate taxes. Another good reason to buy a home is to increase one's wealth by acquiring an appreciating asset. So, I mean, that goes beyond just your primary residence. I know people who have, once they have their primary, they go, Glenn, I'd like to buy a rental property. Glenn, I'd like to buy a second home. That only helps to increase one's wealth because, as you all know, over time, as you pay down the mortgage, you're building equity. As you continue to own the real estate, for most of the real estate, it does appreciate from year to year. So you have an appreciating asset that's also the underlying loan balance is dropping, and you're building more and more equity, which is building more and more wealth. Another great reason to buy a home. But why don't most people buy a home? Well, first off, it's because there's not enough money that they've saved. The second reason is their credit's not good enough. And the third one we've talked about a little bit, they're self-defeating. They don't think they can buy. But if given the chance, would you like to stop renting? Would you like to move but don't have a lot of equity in your current home to give you enough for a down payment? Some of the people that are getting out of condos in downtown Chicago, they're selling them. It was great when they were single. It was great when it was just them and their spouse or their significant other. But now all of a sudden they have one child, they have a second child. They're, where the bicycles go, where do all the toys go? We just don't have enough space, in this condo. So they're moving out, but sometimes they're selling these condos and they're not getting enough equity out for down payment on the next house. Would you like to keep your assets invested? If the stock market has been doing extremely well and not liquidate them for a down payment or for closing costs. And lastly, if given the chance, would you buy a home for 1% of your own funds? When I bring the last topic up about buying a home for 1%, most people are like, tell me more. This is amazing. You're telling me a $200,000 home can be bought for $2,000? You're telling me that a $300,000 home can be bought for $3,000? Well, that's less than my first month's rent and security deposit. Please tell me more. Again, there's some exciting loan programs that we have an opportunity to talk about, and we're going to talk about the ones in red below. But there's 100% on VA loans. There's 100% financing on USDA loans. There's 97% if your credit score is extremely good, that you can only put down or have to only put down 3% for a conforming loan. There's the typical standard conforming loan is 95% financing, 5% down. A standard FHA loan with scores as low as 580, you can get 96.5% financing with 3.5% down. There's something called a buy and fix up loan. We just closed one of these yesterday where they're getting 96.5% of the purchase price and they're getting 96.5% of the repairs. I think they were doing about $35,000 worth of repairs. And the borrower, the customer, got 96.5% of that $35,000 in the loan so that they could make this their dream home. There's also then the three that we're going to talk about in greater detail today is about this $6,000 IHDA access called a forgivable grant. The $6,000 is a forgivable grant. You will be given the $6,000 if you meet the two criteria that you need to qualify. The two criteria happen to be a 640 or better credit score, which most people have a better than 640 credit score. And the second thing is they have to make less than $109,200, which I don't know about you, but I know a lot of people that make less than $109,200. Once they have those two green lights, they need 1% of the purchase price as their own fund. So again, if they're looking at a $200,000 home, they need $2,000. If they're looking at a $300,000 home, they need $3,000 of their own funds. And the $6,000 forgivable grant is forgivable over 10 years. And I got another slide that'll go into it in greater detail, but it is forgivable over a 10-year period. The $7,500 IHDA Access Program is a zero interest loan with deferred payments for 30 years. Fancy way of saying that is here's $7,500. There is no interest on it. Okay, so we're not going to charge any interest. And we're not going to send you a bill for any payments for 30 years. I'm going, where was this when I was trying to buy a house? $7,500, no interest, no payments, and the only time you have to pay back the $7,500 is when you're selling the house and moving. Well, that's a great deal for me. It's a crazy great program. And once again, you'll still need 1% of your own funds, toward the purchase price that you have to put into the transaction. Lastly, the $10,000 program, and I start always people out in the $10,000 program. If they don't need that much, then I back them off to the $7,500 to the $6,000. But the $10,000 program is very similar to the $7,500. It is a zero interest loan with monthly payments of $83.33 per month. It's another way of saying it's a 10-year repayment program of principal only. So when 10 years times 12 months, that's 120 payments. When you divide 120 into $10,000, you end up with $83.33 a month. So if you look at those three programs, 2 out of the 3 require no payments. The $6,000 is a forgivable grant. There's no payments on a grant. The $7,500 is a zero interest loan with no payments. So two of the 3, there's no payments. And the third one, there is a payment of $83.33 of principal only. And usually when I'm talking with a customer, I ask them, I go, if you were to take your significant other out for a nice dinner, glass of wine, what would it cost you these days? And they say, Glenn, it depends on the restaurant, but it might cost us $60, $80, $100. I go, well, could you give up one of those meals per month, such that you had $83.33, and I can give you $10,000 toward your down payment and your closing costs? And they go, absolutely, let's get started. I can easily do that. So again, some exciting programs, many of which are not known by the consumers out there. So it's really up to me, up to you to educate them, to shout it out, to get it out there in social media, to get it out there in Facebook and Twitter. It's our responsibility to let people know, to get flyers and put them into people's hands as we greet and meet people every day. As salespeople, that's our job. We're meeting and greeting people. But wouldn't it be great to be a really great educator? So let's get some more education here and see what we can talk about. So here's the IHDA access programs. There's the $6,000, the $7,500, and the $10,000. Just saying it once again, the $6,000 program is a 10-year forgivable program. Forgiven over 120 payments, no monthly repayment. And let's just use an example. What happens if somebody doesn't stay 10 years? Because it's forgivable over 10 years. Let's say that I stay in the house for 6 years, but my family grows. I have one child, I have a second child, and all of a sudden they go, you know what, this 2-bedroom condo or this 2-bedroom townhouse, it's just not big enough. We need to go to the 4-bedroom house. So we're selling the house. So after 6 years, $4,000 of the $6,000 has been forgiven. So the $2,000 still remains. Well, what happens when you sell a house? Well, your attorney calls up the first mortgage lender. Says, hey, send me a payoff letter. What do we owe still? What's the remaining balance on the first mortgage? And they send that into the attorney, and he's going to make sure it gets paid off at your closing. Same thing. They're going to see on title that there's a lien by IHDA on this $6,000. They're going to send in a payoff request to IHDA and say, how much is still owed on this forgivable grant? And they're going to come back and say, well, it's only $2,000. So you will pay off any unforgiven balance upon the closing or upon the sale of your home. Live in the house for 10 years, there is no balance. It's zero. Congratulations, you've been able to use the $6,000. On the $7,500, the term is, again, 30 years of no payments or whenever you sell the house. Because obviously, it's a zero interest loan. There will be a second lien on title. If you were to sell the house after 10, 15 years, again, your attorney's going to call up the first mortgage lender, say, what is the balance? They'll send in the payoff letter. The attorney's going to see the lien for the second mortgage from IHDA, and it's going to say that, that there's a $7,500 lien. They'll ask them, what is the balance? And IHDA will say, it's $7,500. There's no interest on it. And they will get paid off. The $7,500 will get paid off at the closing. Lastly, the $10,000 is the only one that's repayable at $83.33 a month, no interest. And if you leave the house, sell the house before the 10-year period, your attorney will get a payoff letter and that remaining balance will get paid off at closing. Pretty simple. Okay, again, this is some language that I've used in Facebook regarding the program. New $6,000, $7,500, or $10,000 in down payment assistance. For first-time home buyers, and please, everybody on this call here, make sure you understand it's and existing homeowners. So what does that really mean? That means it's everybody in the state of Illinois, because you are either a first-time home, you're either are an existing homeowner, or you want to become a first-time home buyer because you're not a home buyer, you're a homeowner. So it's everybody in the state of Illinois. There is no restriction on who can use this. And there is no county restrictions. I mean, it's everywhere in the whole state of Illinois. So it's an amazing program. Your journey toward homeownership just got easier. You can get up to $6,000 forgivable, $7,500 deferred for up to 30 years, or $10,000 in a zero interest repayable at $83.33 per month. If you could get $10,000 today to use for down payment or closing costs, would you buy today? See if you qualify. Click this link. Don't keep it a secret. Click the share button and let your friends know how they also can purchase for as little as 1% of the purchase price. So let's look at some of the IHDA eligibility requirements. Well, first off, it's available, we said, for first-time and for non-first-time home buyers within the income and purchase price limits. Well, you'll see I have a chart coming up, but the income limit is $109,200. That's pretty big. I mean, there's a lot of people that fall under $109,200, and it's not household income, it's borrower income. So again, let's use a quickie example. From an income point of view, let's say that the wife makes $50,000 and the husband makes $70,000. Okay, well, 70,000 and 50 is 120,000. Well, that's over $109,200. Those are the old rules. They would not qualify under the old rules because they made combined in the household more than $109,200. Now, however, if the borrower, let's say that the husband made $70,000, $80,000, $90,000, but his $90,000 a year was more than enough income to qualify him for the purchase of their home. And again, Glen uses as a rough rule of how much of a loan they might qualify for. I use 4 times their gross. So if somebody makes $90,000, 4 times that is $360,000. Well, that's a big number. So again, even though the wife makes, let's say, 50, he makes 90, combined they wouldn't qualify if only the husband is our borrower. The wife can be on title, she can be co-owner, she just is not going to be a borrower. And as such, I'll use the $90,000 guy. He makes less than $109,200. They're going to get the $10,000 in down payment assistance if they so should want it or need it. The other cool thing is, and we're going to see an example of this, that you must purchase a 1 or a 2 unit single family within the state of Illinois. The big thing that I like is this 2 unit. I've put many a person into a 2 unit property. They bought the property for 1% of the purchase price. So again, say a $250,000, $300,000 2 unit. Well, when they can buy it for only $2,000, and let's say that their mortgage payment is $1,500, but they're getting $900 from the second unit. Well, $1,500 is their mortgage payment minus $900 that they receive from the tenant. You're telling me that their mortgage payment is their out of pocket is only $600? That's an amazing way to get people into housing. It's starting to show them that if they can get down payment assistance to help them purchase it, and they buy a 2 unit, the tenant can help cut their mortgage payment in half or better. Great way to put people into housing. Another thing is the borrower must occupy the property as their primary residence. Non-occupant co-borrowers, that we cannot allow for non-occupant co-borrowers. Another way of saying this also is this is not applicable to second homes. It's not applicable to investment property. It has to be your primary residence. And again, you could already have a primary. You could turn that primary into rental. So say you want to put a tenant in there. You say, this is great. I was able to get a 4%, a 3% fixed rate for 30 years, but it's gotten too small for me. But I know that interest rate is so low and it's never going to change for 30 years. And I know I can get rents out of this and my rents are going to increase over time. I want to keep this as a rental. So you can keep a property and turn it into rental because that becomes investment. So then when you're buying your next property and it's going to be your new primary residence, we can use the down payment assistance program for that. Okay, and it's good for 30-year fixed rates, meaning that the down payment assistance program is really the second mortgage. That does not dictate what is the best loan choice for your first mortgage. So you can get a VA loan, you can get an FHA loan, you can get a USDA loan, you can get a conventional loan. You get what's in your best interest, and obviously that's through conversation with your mortgage loan officer. But a lot of people, when they're looking for the lowest down payment, a lot of them are going FHA, and then they're combining that with the second mortgage, the $6,000, the $7,500, the $10,000 down payment assistance program. Here's some of the other program qualifications. And again, we'll look at the income and the property limits in a second. The minimum credit score is your 640 here. You can see that whether it's FHA or USDA, VA, or conventional, they're all at 640. So again, we deal with people that come to us and say, hey, Glenn, I want to be a homeowner. Steve Tassi sent this in, we understand you're part of his team. Yeah, I'm going to fill out the application. I know pre-approval is free. Please run my credit. We run credit. It's at 610. So then we have a choice to make. We will give them, we'll do a what if, or not what if, a what if analysis. We can go into our computer and we can say, hey, this customer needs 30 more basis points. He needs to go from 610 to 640. What are the steps that he can take in order to do that? And the computer will come back and say, pay down this credit card, pay off this collection. It'll tell us exactly what to do. We give that to them as a homework assignment. So again, minimum credit score, 640. And if they don't get to that point, then what we're going to do is we're going to put them into a program where we will follow up with them in 30 days and say, how you doing? Have you followed your program? Did you take care of your action steps? So again, it doesn't mean that we're not going to use down payment assistance. We're going to be delayed maybe by 30 days, 60 days at most, while they take care of their credit challenges. Again, the maximum debt to income ratio cannot exceed 45%. Okay, that means your numerator is your monthly debts. That means your housing payment that consists of PITI, principal, interest, taxes, and insurance, plus your minimum payments on credit cards, plus your car loan payment, plus your student loan payments. When we add up all the monthly payments, that cannot be more than 45% of your gross income, not your net take-home pay, but your gross before withholdings. And the borrower must contribute 1% of the purchase price or $1,000 of their own funds, whichever is greater. Typically, the people that I'm dealing with, it's 1% of the purchase price. But if the purchase price is under 100,000, say it's 90,000, 1% of that is $900. Well, they have to come up with at least $1,000 then of their own funds. And homeownership counseling is required, and it's an online little mini course. They take the course, they get a completion certificate, and we put it in the file. The interest rates, there's only one interest rate offered each day by IHDA. And I have on the next slide an example of what the rates are. Extremely low. The thing that I like about, and I emphasize the one interest rate, this is not a program that they have to shop around for. Well, let's see what First Centennial has. Let's see what Harris Bank has. Let's see what Bank of America has. There's only one rate. It comes out at about 9:30 every morning. IHDA sends it out to all the IHDA lenders. And if any of you ever hear that somebody, a lender, is telling you, oh, avoid the IHDA program. Oh, it's terribly complicated. Oh, it's going to delay your closing. You need to ask them back, are you a certified IHDA lender? Because that's the people, the non-certified lenders, the ones that cannot offer the program, they're the ones that are saying negative things about the IHDA program. There's 4 additional pieces of paper that we send to you, to the client to sign at the time of application. Our underwriters underwrite the file for IHDA at the same time they underwrite the first mortgage. So there is no delay in underwriting. There's no delay in your closing. So again, this is a great program. The interest rate is the rate for the borrower's first mortgage. Remember, there's the program, it's a grant has no rate. The 7,500 is zero interest, there's no interest rate. And last but not least, the 10,000 has no rate also. So again, the interest rate that we're talking about under the IHDA program will be what the borrower's first mortgage loan interest rate is on their FHA loan, on their conventional loan, on their VA loan. And the IHDA down payment assistance program is a second lien on the property, with only the $10,000 program requiring any repayment, and that's at $83.33. Let's take a look at the rates. If you notice here, under the access 10%, that's a $10,000 program. You see in the column called government, that's FHA and VA, the rate is only 3%. That's really low. Now again, if you have to say if there's anything negative about the IHDA program, because what couldn't be better than I get $10,000, I get $7,500, I get $6,000, and I don't have to pay it back. Part of it's forgiven. I don't pay it back till I sell, or I pay only $83.33. It's all great information. I can buy for as little as 1% of the purchase price. The negative is the interest rate is typically about 0.5% higher than what someone would receive if they did not use the IHDA down payment funds. So if you don't use the $6,000, the $7,500, or the $10,000, if you've got the money in the bank and you want to use it, your rate for, say, an FHA might be as low as 2.5%. But again, I've been doing this for 7 years now, and we're one of the few certified IHDA lenders. And as such, I have yet to have anybody come back to me and say, Glenn, that rate is ridiculous. That's terrible. They want to get into housing. They want to buy a house. They want to be a part of the American dream. This 3% is that's it. Great. Love it. This is fantastic. And that is the interest rate that'll be on their FHA or their VA loan. On the other column, conventional, it says 3.25% on that 10% repayable. And that would be what they would, if they went with a conforming loan, where they'd be putting at least 5% down, that's what they would be getting for an interest rate. And again, it's about 0.5% higher than what someone would get if they did not use the IHDA program. Let's take a look at income and purchase price limits. When I keep talking about $109,200, we are in Cook, DuPage, Kane, Lake, McHenry. It's Cook in all the collar counties. We're at $109,200. If you get out to some of these other counties, like DeKalb is only $100,920. Grundy is $106. Here's Kendall, $128. Most of my business is in the Cook and the collar counties. So that's why I talk a lot about the $109,200. But if somebody came to me in one of these other counties, I would look it up and I would tell them, yes, your income is qualifying. It is under the maximum income limit. And then look at this. The maximum purchase price in Cook, DuPage, Kane, in the collar counties is $326,781. If they're buying a 2-unit, $418,000. Well, I know a lot of realtors who tell me, Glenn, most of my listings are under $326,000. So if you're out there listing or showing buyers homes under $326,000, why are you not at least offering to them the opportunity to take advantage of down payment assistance, get them up to $10,000 so they can keep $10,000 of their own funds for accessorizing the house, for that lawnmower, for that rake, for that snowblower? You would look fantastic in the eyes of the buyer if you at least gave them the opportunity to think about, should I take advantage of this $10,000 or $7,500 or $6,000 program? And that 2-unit at $418, that buys a pretty nice 2-unit property at $418,000. So let's use an example. Let's say that somebody's looking at buying a $200,000 home, and this is what I call the 3 buckets of cash needed at closing. If you can explain, there's always going to be 3 buckets of cash. And again, I'm not trying to say you guys should become loan officers nor lenders, but I want you to at least be able to think about in terms of simple terms. If you can tell a potential buyer, 3 buckets of cash are needed. We've got to satisfy each of these buckets, and let's see who pays each of the buckets. So let's go through these 3 buckets slowly here. So if the purchase price is $200,000, and my down payment could be 3, 3.5, or 5%, 5 or 3 if I'm going conforming, 3.5 if I'm going FHA. And since we don't know enough about the customer, let's go with a low down payment of 3.5%. We don't know if they have the best credit to get to the 3, so use 3.5. The IDA program has a $10,000, $7,500, and $6,000 program. So let's start out with the biggest program, $10,000. And the average closing cost on a purchase is $5,000. And there's an additional IDA origination fee if they use the IDA program that's equal to about 1% of the loan amount, or about $2,000. Okay, so those are our assumptions. Now, the 8th grader in any renter, in any first-time home buyer says, I know what my out-of-pocket is. I've talked to the landlord, I've read the lease, and it says I got to give them a first month's rent of $1,500, and I got to give them a security deposit of another $1,500. I'm going to be out of pocket $3,000. They get it, they understand it, they know what the risk is. Okay, they sleep well at night. Buying a home, ooh, there's a lot of moving parts there. That's scary to them. It's scary to anybody who, if you can't articulate and quantify 3 buckets of cash. So let's break it down for them. Bucket number 1 is down payment. Okay, you told me my down payment was 3.5% of $200,000, so it's $7,000. Well, initially, the person that's got $3,000 says, Steve, Glenn, what are you guys talking about? I don't have $7,000. I told you I got $3,000. Show me a rental unit. But then you have to say, who pays? Remember, your customer has come up with 1% of the purchase price, $2,000. We need 7. So where do we get the other $5,000 from? From our IDA bucket. We got $10,000 sitting in our IDA bucket. Take 5 out, 5 and 2 is 7, put a check mark, you get all the money you need. Now remember this, when you're talking typically to a renter or a first-time home buyer, they have $3,000 typically in the bank, voluntarily or involuntarily. Let's go through both examples. The voluntary one is where they're looking around, the children are getting older, they're having to go to school, they're gonna be walking to school, and they think the neighborhood's getting more dangerous. They don't like the neighborhood, they don't want, or they don't like the school area, so they wanna move. They wanna go from where they're renting to some other place where it's either a better school or a safer neighborhood. So they're prepared, they've got the first month's rent and security deposit. That's voluntary. Involuntary is the landlord tells them, hey, lease is coming up in a couple of months. I want to let you know ahead of time that I'm not renewing the lease. You've been past due 3 or 4 times. You're noisy. I get complaints from the other tenants. You're just not my ideal tenant that I'd like in this building. So start looking. So again, they have their $3,000, their first month's rent and security deposit. So they've got the $3,000. They don't have the $7,000, and you just showed them how they only have to use $2,000 to come up with their bucket number 1. Go to bucket number 2, closing costs. We just said it's $5,000 for underwriting and for appraisals and for title charges and all that great stuff. And we're going to give them a detail of that in what's called a loan estimate. But at this point, when we're just trying to get them to understand how they can become homeowners, we're telling them all those little ticky-tacky fees are going to cost about $5,000. And there's an additional $2,000 fee for using the IDA funds. So it's $7,000. And again, they say, Steve, Glenn, I got $3,000. In fact, I don't even have $3,000. You just took $2,000 in bucket 1. I'm down to $1,000. How the heck can I, afford this $7,000? You say, who pays? Well, first off, the biggest person that can pay is IDA can pay the remaining funds. You had $10,000, you used $5,000 in bucket 1, you still got 5. So then you still have $2,000 to make up. Well, isn't this where you come along? You, the fantastic realtor. Why wouldn't you say, let me, and again, you should be using this worksheet. It's an Excel spreadsheet. It's interactive. It recalculates whenever you change the purchase price, it changes. And again, if anybody wants this sheet, why don't you just put into the chat box that, Glenn, please send me the 3 buckets of cash. And so you're going to negotiate for your client with the seller that they give you $2,000 worth of closing costs. 2 and 5 is 7. You got all the money for bucket number 2. Put a check mark. You're done. Now, again, we'll talk later on in this presentation about, again, if the seller, is not willing initially to give you $2,000, and let's say the listing price is $200,000. The closer you get to the $200,000, and the more you even go over, if you offer $202,000, such that then the seller can provide $2,000 worth of closing costs, you have opportunities to get that $2,000 for your client. So making the assumption that the seller will give you that $2,000, we have all the money we need then for the closing costs, and our customer in yellow here has come up with 0 out of pocket. Let's go to bucket number 3, prepaids and escrows. Escrows are a fancy term for deposits. Deposits for what? For the real estate taxes that the lender is going to pay twice a year, and for the homeowner's insurance premium, protected against fire and damage, and that gets paid once a year. But again, who pays that? Depending upon, typically at closing, you got to come up with 2 months worth of homeowner's insurance and put it into the escrow. Depending on the month that you close for your real estate tax escrow, you might have to come up with 2 months to 8 months worth of real estate taxes and deposit it into the escrow. Well, that could be thousands of dollars. But the cool thing is, what we don't realize is that the seller is going to give our client a real estate tax credit. And the credit always, always, always is greater than what the lender is going to ask you to initially put up into the escrow at closing. And why do we know that? Because in the state of Illinois, we pay our real estate taxes 1 year behind. So here we are in the year 2020. So therefore, our real estate taxes for the year 2020 will not get paid until the year 2021. Well, if we have a closing on, let's say, September 30th, who lived in a house for the first 9 months of 2020? The seller did. So the seller is obligated at closing to give our customer, the buyer, 9 months of real estate taxes as a credit. And the credit always is greater. In fact, it's so much greater that it really becomes a negative number. But again, from a simplistic point of view, I try not to show negative numbers. I just let them know there is no money out of pocket for our customer in yellow here, bucket number 3, that they have to come up with for their escrows, because the real estate tax credit funds everything that we need in that bucket. So going in reverse, if it's 0 for escrows, 0 for closing costs, and $2,000 for down payment, 2, 0, and 0 is $2,000. So I asked my client, would you rather come up with $2,000 and own a $200,000 home, or would you rather pay $3,000 to a landlord and end up owning nothing? I think the answer is pretty self-evident, but I like at least offering them the opportunity to give me a good answer. Now, what if the earnest money, kind of a short little quiz for you guys here, what if the earnest money was equal to 1% of the purchase price? Interesting comment, interesting question. How much cash would the buyer then have to bring to the closing? So again, if we went back to the sheet here, if this $2,000, which is what we have to come up with for all 3 buckets, if that was given as earnest money, then at closing, our customer's really coming up with no money. Wouldn't that be a great conversation to have? Wouldn't that be a great conversation when all of a sudden they call up our processor and she says, yeah, for your closing, you don't have to bring any money to the closing, or it's minor. Bring your checkbook. You don't have to go get a cashier's check. You have $149 that's owed at the closing. Great conversation, but again, not many people realize that if you as realtors set up the purchase contract where the buyer is giving 1% of the purchase price as the earnest money, they literally can come up with little to nothing at the closing. Let's take a look at it from a different perspective. What if the purchase price was $300,000? Okay, you say, well, 200,000 is not going to get them too much. I want to look at 300,000. Remember, what's the maximum? It's that 326,000 and change, but let's just round numbers, say 326,000. So if they buy a $300,000 home, the down payment of 3.5%, that means that they got to come up with $10,500. Way bigger. They go, oh my God, I only have 3,000. I don't have the 10.5. And so once again, you say, but who pays? I need you to pay customer $3,000, 1% of the purchase price, and I'm going to put that into the earnest money when we make an offer. Therefore, the remaining funds has to come from IHDA. They got $10,000. We're going to take out $7,500. 7,500 and 3,000 is 10.5. Put a check mark. You get all the money you need for the down payment bucket. Bucket 2, closing costs. It's 5,000 normal and the 1% fee. You got $8,000. Okay, in order for our client to come up with no money, we're going to take the remaining funds from IHDA to help us pay for that. They already used 7,500 in bucket 1 of the 10,000, so there's $2,500 remaining. So Realtor, you're going to be the champion. You're going to negotiate for your client. You're going to get $5,500 or more in having the seller pay $5,500 in closing costs. You do that, our customer will come up with $0. Again, when you get this interactive spreadsheet, if the seller can only come up with, say, $4,000, then another $1,500 would pop up into the yellow box here. And so they would be coming up with a little bit more than 1%. But I'm the optimist here. I feel that the realtors have the power, the ability, and the negotiating skills to get the closing costs, or you're going to find them a property where there's a motivated seller that will help get them $5,500 worth of closing costs. I've seen it time and time again. And again, that's what you do that's why you're worth the commissions that you get paid, because you're going to find that house, find the motivated seller, and you're going to negotiate in their best interest. Last but not least, because in the escrow bucket number 3, the real estate taxes are going to be a credit to our customer. So it's a 0 out of pocket. It's 0 out of pocket in bucket number 2 because of the IHDA program, because of the seller paying closing costs. And in bucket number 1, we've paid $3,000, or the customer has, and IHDA's paid the rest. So for $3,000, with that strategy in mind, they just bought a $300,000 home. I don't know about you guys, but to me, that's exciting. That gets people very interested in saying, hey, I want to get off the couch and I want to go looking at houses. I don't want to just give $3,000. Yeah, you could give $3,000 to the landlord, own nothing. But wouldn't it be great if you could buy a home? And this again all presupposes that they meet that their income supports a $300,000 home. Now, so what is our housing payment? What is it, under this IHDA program? Go back to that $200,000 home. The loan amount is going to be $196,377. So the breakdown of the payment is going to be principal and interest, $828. The down payment, if they use the full $10,000, the principal payment is $83.33. The taxes are this. The homeowner's insurance is $75, and the private mortgage insurance is $135. So they're going to end up with a payment of $1,455. If their rent is $1,500, you just put them into a place where it's less than their rent is paying. They're now owners, and they just bought the place for less than their first month's rent and security deposit. You look like a champion. This assumes a 3% interest rate. You saw that on the IHDA rate sheet, that right now it's at 3% on an FHA 30-year fixed rate. But what if this was a 2-flat? You can subtract the rent received to determine the net payment to the customer. What if they were getting $900 a month in rent from the second unit? Well, 900 from 1,455 means that they're out of pocket each month is $555. Do you think you would get some people excited if you showed them that? So here's an example of a 2-unit. Someone was buying this as an actual example of one of my realtors. They had 189.9 2-unit. Bucket one was 6,646. Who paid it? The borrower came up with 1%. IDA came up with the rest. Bucket number two, the closing costs were 5,000. IDA paid the remaining 5,000. So IDA, we used the $10,000 program because we used up most of the funds. And then in the third bucket, it was zero. So again, the customer came up with only $1,899 to buy the 2-unit. And then, if you come down here to the bottom, the breakdown of the payment between principal and interest, taxes, insurance, private mortgage insurance was $1,417. The $1,417 minus the second unit's rent of $825, their monthly housing payment, the customer's housing payment, was $592. Do you think that customer had a lot of positive things to say about that realtor? Absolutely. Because first off, they had no idea that they could buy the doggone 2-unit for as little as $1,899. And they had no idea that their housing payment would only be $592. Fantastic approach, fantastic layout to the customer. So let's talk about some common questions here. How much of a down payment do I really need to buy? How much savings do I need in the bank? How good does my credit need to be? What's a fixed rate versus an ARM? What does my housing payment consist of? What are closing costs? What are escrows, and how much loan do I qualify for? So again, how much cash do you need at closing? We've gone through the 3 buckets. Bucket one is down payment. How much do you pay? You can pay as little as 1% if you use the IDA program. If you don't, you're going to come up with 5, 3.5, or 3% depending upon your credit score. So again, bucket number 2 will help determine how much cash you need at closing. Your closing costs can be $5,000. They can be as much as $7,000 or $8,000 if you use the IDA program, and then you always have to ask who pays. Bucket number 3, escrows. Once again, the lender's going to have you set up your escrows for your homeowner's insurance and for your real estate taxes, but who pays it? Well, the seller's real estate tax credit really pays it. We've already talked about down payment. So how much cash is needed for bucket number 2? Let's take a look at that a little bit further. We said that it's approximately $5,000. There's an additional 1% fee if we use the down payment assistance program. And it could be paid by the borrower. Yeah, it could, but that's not the most exciting way. It could be paid by IDA. And again, if we have all the funds are still there, we can use all of IDA. If we don't have, if we run out of the $10,000 in IDA, then we can ask the seller to either outright agree to pay the closing costs, or we can ask the seller to pay whatever we need, $2,500, $5,000 more for the seller's home, provided the seller pays $5,000 of the closing costs. This is not your first discussion. We're going to talk about setting a table of expectation. There has to be an idea or an agreement between the buyer and the seller as to what the purchase price is going to be before you gross up the purchase price to the seller, asking them then to pay the closing cost with the increase in the price. So how much of your own funds were used for the closing costs? My guess is going to be 0, because you're going to use IDA and you're going to be smart enough to negotiate and have the seller fill whatever void or whatever is left or remaining funds are needed to pay the closing costs. So we're talking about closing cost assistance from the seller. In order to get closing cost assistance from the seller, you must first set what's called the table of expectation. It's a price that's agreed upon between a willing buyer and a willing seller. So again, if I list my house for $200,000 and I get an offer for $195 and I counter at $198, okay, and we agree, now we've got a basis. We've got the table of expectation has been set. Both buyer and seller have agreed at $198. So what you're going to do is you're going to ask a realtor to find homes. If you're looking for the seller to provide seller concession or seller helping you pay for closing costs, the realtor needs to find homes with motivated sellers. The home has to maybe had another profile could be that the home has had at least one price reduction, or it's had many days on the market, Typically then the seller is more motivated. Great, you're making me an offer closer to my listing price, but you want me to pay for some closing costs. I think I can do that. A motivated seller will sell for less. A motivated seller will allow you, the realtor, to gross up the purchase price and then will participate in closing cost assistance. You offer the seller a higher adjusted price by the amount of the closing costs. So again, if I'm dealing with, if my table of expectation is $200,000, we negotiated back and forth. Listing was 210. They offered 195. We met in the middle at 200,000. I even have a written offer at $200,000. But now it really is the buyer's realtor. You will then call up to the seller and say, excuse me, my client no longer wants to pay $200,000. There's a big sigh and a big moan on the other end of the phone saying, what are you talking about? We just agreed, we put into, you're putting into writing, you're filling out the contract for me, and you don't want to pay $200,000. What gives? You say, nope, my client wants to pay more. My client wants to pay $205,000. You wait at the other end of the phone and there's a smile and a giggle and go, what do you mean 205? You said they're going to pay 200. Well, they want to pay 205,000 provided your client will pay $5,000 worth of closing costs. Well, 205 minus 5 is 200,000. So you've already met that table of expectation. The seller's accountant, the attorney, the realtor representing them, they go, well, you're getting $200,000. They're just grossing it up so that you can pay part of the closing costs. And there should be no objection to that because you're getting back to the table of expectation. So what's people's reaction to something like that? Well, the seller's very happy, still receiving his table of expectation price. The realtor's very happy because they're getting paid more commission on a higher price. Why not? The buyer's very happy because how much of his own funds did he use for the closing costs? Well, if he used IHDA and the seller, the answer is he used zero. He used the IHDA and he used the seller. So now let's talk about escrows, the third bucket. Escrows come, there's two items really in the escrow bucket. One is called prepaid interest and the other is escrows for homeowners and real estate taxes. On prepaid interest, you're going to pay interest from the date of the closing to the end of the month. Therefore, most realtors will set up a purchase such that you're going to be buying your home at the end of the month. So in other words, if you purchase on September 30th, you're going to be only using the lender's funds for one day, September 30th. So you only have to come up with 1 day's worth of interest to the end of the month. If you close on September 20th, well, you're going to be paying prepaid interest from the date of your closing, September 20th, to the end of the month, September 30th. You'll come up with 10 days worth of interest. So again, why do most realtors then set it up for the end of the month? So that you come to the closing with the least amount of money or the least amount of prepaid interest. Cool. The second thing is escrows. Typically, you're going to come up with 2 months of homeowners insurance. So again, 2 months, the assumption here is that you're going to first go get a paid up policy. Let's just say for sake of discussion, the policy costs $360. Okay, so you will show evidence to the lender, to the lender's processor that you got a full 12-month paid up policy. Well, however, at the closing, you're going to be asked to set up 2 months into the escrow in anticipation of next year's premium. And we're going to collect 1/12 of that premium every month, such that by the time 1 year comes around, we'll have two months that you set up at closing, plus 12 during the year. There'll be 14 months worth of homeowners insurance in there. So again, if it's a $360 premium per year divided by 12, that's $30 a month. 2 times 30, you're going to set up $60 for homeowners insurance. Great. Then go to the real estate taxes. Depending upon the month you close in, you'll either set up 2 to 8 months worth of real estate taxes in the escrow. The good news in red is all these little dollar amounts, prepaid interest, 2 months of homeowners insurance, 2 to 8 months of real estate taxes will all get offset by the seller's credit for real estate taxes while the seller lived in the home. So what we're saying here is the seller is going to be giving you a credit for the number of months that he lived in the house. The September 30th closing, that's 9 months. 9 months worth of real estate taxes. If the taxes are $300 a month, 9 times 3 is $2,700. You're going to get $2,700 in a credit, such that how much of your own funds are you out of pocket should be 0 for the escrow. So let's summarize the 3 buckets of cash again. How much of your own funds are you using? Well, in bucket number 1, we're using only 1% of our own funds because IHDA paid the rest. Bucket number 2, closing costs, should be 0 with IHDA and the seller paying the closing costs. In bucket number 3, escrows, should be 0 with the seller credit from the real estate taxes. So what are we waiting for? What type of action should we be taking? Well, now that we've reviewed how little cash is needed, how do you meet the 3 C's of lending? The 3 C's are credit, cash flow, and collateral. So credit, we said you need a minimum of 580. If you're going to use down payment assistance, it's 640. Okay. And again, if you don't have a 640, we'll work with you, give you a homework assignment, and tell you what you got to do as far as paying down credit cards, collections, and anything else to bump your credit score up to 640. The other C is cash flow or gross monthly income. Under the down payment assistance program, the maximum debt to income ratio cannot exceed 45%. Another way of saying it is take your gross income, your gross monthly income, multiply it by 45%. That's the maximum that your housing payment can be, which is principal and interest, taxes, and insurance, and private mortgage insurance, plus your minimum credit card payments, plus your student loans and your auto loans, cannot be more than 45%. If it is over 45, we can go up to 50% on a conventional loan, and we can go up to 55% on a standard FHA. But both of these, conventional and standard, are not using down payment assistance programs. If you use the down payment assistance program, the max is 45%. And since we're only talking about getting people qualified and pre-approved, collateral is the appraisal, and that comes about once they're under an application, they're into our processing department. We'll order up the appraisal. We'll find out whether or not they meet the last C called collateral value. All right, credit. Going back to the first C. Credit is obtained from, your score is obtained from any one of the 3 national repositories: Experian, TransUnion, Equifax. Lenders take the middle score of the 3. It is not an averaging, and typically it's TransUnion here in the Midwest and Illinois is your middle score most of the time. Your scores can be from 0 to 850. Again, we're looking for a 640 or better credit score. See here, need at least a 580 if you're not using down payment assistance, and a 640 if you are using down payment assistance. And then down here, it talks about credit rescore versus credit repair. If you don't have these scores, let's first talk about credit rescore. Credit rescore says you're running high on your credit cards. You've got a $1,000 credit limit on Visa, and your balance is $980. Well, you're $20 away from the max credit limit. And you got maybe 2 or 3 of these kind of cards. You might have a collection, a new collection. And so credit rescore means you can take action. You customer, you can go and take funds and pay down your credit card to 10% of that $1,000. You can pay off that collection and then come back with your little pieces of paper and give them to us. We will send them into our credit agency, and they will work with Experian, TransUnion, Equifax, and they will rescore your credit score. And again, it goes back to our what if analyzer. We can tell you approximately what that score is going to be if you take these action steps. Now, credit rescore, that typically takes about 30 days. The customer's got to go away, they got to take action, they got to pay things down, they give us back the paperwork. Okay, 30 days. Credit repair is totally different. Credit repair we don't do, but there are companies, and we deal with companies and refer you to these credit repair companies, where somebody has got no good trade lines, or a majority of them are not good. They've got collection after collection after collection after collection. They haven't paid anybody in years. And they've got a score of 475. They got a score of 525. They need someone to hold their hand and to negotiate with the creditors. if I've got $400 balance owed to Visa, I need somebody to possibly help me negotiate to pay 50 cents on the dollar, 30 cents on the dollar. So again, that's part of what credit repair does, is they work with and for you to help you reduce the amount, settle with your creditors, advise you who you can go to get secured credit cards, to reopen up credit, start using credit. They will work with you. It's a longer process. It's 3 months plus. But again, both of those are available for either referral or on Credit Rescore for us to work with your clients in order to get them into one of these programs. Now that you have the credit score, assuming that you're above 640 or above 580, let's look at cash flow. Cash flow is income. So what you're going to do is you're going to add your housing payment to your minimum payments on credit cards, car loans, student loans, and other debts. Okay, so that's going to be your total household debts, housing and all other consumer debts. You're going to then calculate your gross monthly income, not net take-home pay, gross monthly. Most people get paid twice a month, so you might take your paycheck twice a month. There's 12 months in a year. That's 24 times you're going to get paid. Take the gross amount on your paycheck, multiply it by 24. If you get paid every 2 weeks, multiply it by 26, and that's going to give you your gross income divided by 12. You're going to keep your monthly debts to gross monthly income under 45%. I'm going to take a little sip here to clear my throat. You're going to keep your monthly debts to gross monthly income under 45% if you're using down payment assistance. As you've seen on the previous slide, we can go to 50% on conventional and 55% on FHA if you do not use down payment assistance. So again, what does your housing payment then consist of that we're talking about here? Well, again, your housing payment, and again, I can't emphasize enough, if you make a note here, I would get, after this class is over, please download FCM Express by going to your App Store or to your Play Store, and it has a great calculator on it for you. It's going to help people on purchases or refinances understand what their monthly payment could be. And your payment's going to be, it'll calc for them the principal and interest. It'll break out the homeowners insurance, the real estate taxes, your private mortgage insurance, your flood insurance, and any type of HOA or condo association dues. Great calculator. So again, if I'm a novice and I'm trying to figure out, well, hey, Steve, you're showing me this really cool townhouse, or hey, you're showing me this really great house at $300,000. What's my monthly payment? They can go right to FCM Express, because once you have FCM Express, there's only two things. It'll be a little icon on your phone. You press the icon, and when it opens up, it's going to ask you realtors two things. Would you like to start an application? Oh, no, you're not applying for a loan. But the second question is, would you like to share this? And absolutely, you'd like to share it. You're sharing it with a client that would like to know what their monthly payment is. So you click share, it asks for their phone number, you text them the FCM Express, it opens up for them, and they're able to then calculate this payment. Once again, from a technology point of view and giving immediate gratification to people, this is the route to go, FCM Express. You can also give them instant gratification. They want to go looking at housing. You want them to get pre-approved. How better than to go FCM Express, because then when it's on their phone and they open it up and it says, would you like to start an application? That's their button to press. They don't want to share it. They want to start an application so they can get pre-approved. And it will prompt them for whatever documents are needed, like W-2s, pay stubs, tax returns. So again, if I were to download FCM Express on a $200,000 home and the loan's $190,000, it'll tell you what the loan amount is. If it's FHA, it'll show you what your loan amount is. It'll calculate the principal and interest, the down payment assistance program, the real estate taxes, homeowners, private mortgage insurance, and you're going to come up with a total of $1,455. This again assumes a 3% interest rate on an FHA 30-year fixed rate. And what if, again, it's a 2-flat and you get $900, let's say, such that now you're only out of pocket $555. What a great way to own real estate. And again, you calculate your gross income as follows. If you're on salary, it's the gross salary. If you get bonuses, we can average in the last 2 years received bonuses. It's not that, hey, you're going to get a bonus in the future. We can't use future earnings. We can only go by your last 2 years historical bonuses. Commissions, the same thing. If you're a loan officer, if you're a realtor and you work on commissions, your qualifying gross income for a mortgage loan is the last 2 years worth of commissions actually received. Over time, 2-year average. The self-employed, anybody who is self-employed, that means somebody who owns more than 25% of an entity. If myself and Steve, we own a real estate company, and I'm 50%, Steve's 50%. Each one of us is considered self-employed because we own more than 25%. We would be looking for the tax returns of that business, and 50% of it would be attributable to my gross income for qualifying purposes, and 50% would be attributable to Steve. I would be looking at the net. This is the only time net versus gross. I'm looking at the net income of that self-employed business, and it'll be averaged over 2 years. The reason I'm emphasizing net for the self-employed is I've had people, a golf pro, I had a golf pro, said he made about $70,000 in fees giving lessons. He says, so I should be able to qualify, I make $70,000. But then when I got his tax return, he wrote off $50,000 worth of wining and dining and golf clubs and entry fees and all. And so he spent 50 grand. So his net was 20,000. And I said, you only got $20,000 left over here to help pay for mortgages and your consumer debt. So he qualified for relatively little to nothing. But so again, whenever you're self-employed, we're going to use the net. The other thing about all of these where we're averaging is if your income is going down from 1 year to the next, we will not average over 2 years. We'll use the most recent year because you're in a declining income scale. So again, typically it is though a 2-year average, so keep that in mind, and this is how you're going to qualify someone for gross income. How much loan can I afford? A general rule that I mentioned early on said 4 times your gross. So again, if 4 times the combined gross income of the borrowers, again, you got to be the borrowers. If just the husband is the borrower and the wife is not, but she makes income, I can't use her in this simplified rule. The maximum loan amount you can qualify would be if the husband makes 40, the wife makes 30, that's 70,000 in total, times 4. 280,000 would be the max loan. And again, that's not how we really underwrite loans, but it's a good walking around rule. It's something that's easy to talk about, and it helps people understand, well, if I can qualify for 280 and I got 20,000 in the bank, well, we can go look at homes for 300,000. The lender rules are more specific. They use debt ratio to determine if you qualify for a loan. The housing ratio, which is the monthly amount you spend on housing, the principal, the interest, the taxes, the insurance, as a percent of the total gross monthly income. Same thing with your overall debt ratio, which is the monthly housing plus the consumer debt as a percent of your gross monthly gross income. And those ratios typically cannot exceed 45% for down payment assistance, nor up to 55% FHA without down payment assistance. So your goal of your homework today would be to get pre-approved for free. And again, they can use FCM Express. So your clients can get pre-approved for free, see if they qualify. Let's get their credit score pulled so we see if they're above 640. Obtain a free credit report. See if we need credit repair. See if we need credit rescoring. Assemble the necessary documents, 2 years of W-2s, 2 years of tax returns, 2 pay stubs. Get an automated underwriting approval. Get a pre-approval letter. Now that you have a yes, go find a home with your realtor and review your action plan. If the plan was to pay down credit cards or pay off collections, review your plan and make sure that you stay on task. This is going to be some of the mortgage application documents. I won't go through them in great detail, but it's in here in the PowerPoint for you to share with your clients. All this sounds good, doesn't it? But what can you do as a realtor to grow your business with this? I mean, You're giving away $10,000 or up to $10,000. Well, I would create Facebook posts with landing pages. About 50 people will see this, and these are going to be your commercials. I would do this on Mondays. I would give them the $10,000 commercial. On Tuesdays, I'd give them buy a home for 1%. Again, going back to the 10,000. If you're given $10,000 today, would you buy a home tomorrow? If what's holding you back from buying a home is because you haven't saved enough for your down payment and closing costs, click this link to see if you qualify for up to $10,000 to allow you to buy a home for as little as 1% of the purchase price. I think you get some people that want to know about how to get $10,000. Same thing is true of 1%. I would do that every Tuesday. But hear my words, the word I'm emphasizing is every. You cannot just post in Facebook one time and say, well, that's it. People know I have $10,000 because I'm in Facebook every single day and I have a different message. One day, every Monday I have a $10,000 message. Every Tuesday I have a 1% message. Every Wednesday I might have how to buy a 4-unit for as little as 3.5% down. You might have every Thursday, what is your home worth? I mean, you guys need to do what's free and easy and takes all of 2 minutes to do and put landing pages in there. But again, first thing I would do to get people interested in my how to buy a home for 1% or how to get 10,000, I'd do a Facebook post. And we're going to take a look at that shortly. I got one here for you coming up. They're your commercials. They're free. They don't cost anything. They take all of 2 minutes. The second thing I do is I create a Facebook ad. To get beyond 50 people, I want to get out to thousands of people. Still put your landing page in there and let them see that if they want more information or they want to see if they qualify for how to buy a home for 1%, or if they want to know if they qualify for $10,000, give them that landing page. Let them click on it. Let them go to it. Let them fill it out and let them, and once they do, you get an email, you get a text message saying that this person would like more information. Another thing, what can you do to grow your business? Ask 30 people per day to be your friend in Facebook. It's free. Don't go over 30, maybe do 20. If you go over 30, Facebook's going to send you a little message warning you that they're going to shut down your account. But I mean, I would go to your friends. Say Glen Marino is a friend of yours. And I'd look at Glen's friends. And I'd look for people that are not teenagers. I would look at people that are mature adults, people that you would say, oh, these people look like they could buy a house. And I'd ask them to be my friend. So you're going to grow your friend base in Facebook. If you run out, so you're going to your friends and you're asking their friends to be your friend. Pretty simple task. That will take you all of less than 5 minutes. Because again, if you went to Glen Marino, you went to my friends, there's a button on the side that says, ask to be a friend, ask to be a friend, ask to be a friend, ask to be a friend. And you're going to go click, 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 and you'll be done. Then how are you going to grow your business? You're going to messenger 30 people per day about your team having $10,000 for down payment assistance. Again, it's free, doesn't cost you anything. I would put in, I've got a quickie small message, but the message might be, hey, Steve, you're a friend of mine in Facebook, and I thought I'd share an awesome program with you. There's now $10,000 that one can receive for down payment and closing costs, helping people buy a home for as little as 1% of the purchase price. Hey, give me a call at this number, and let's have a 2-minute discussion to see if this is for you, your sons and daughters, your brothers, your sisters, or just friends. Boom. Copy, paste, copy, paste, copy, paste, copy, paste, copy, paste 30 times, and you've just gotten your message out to 30 people in Facebook. And for your listings, for your listing agents on this call, why are you not adding to the remarks in the MLS? Why are you not going to the remarks, double spacing down, and saying, you could, if your listing is under 326,000, I'm making the assumption here that the listing is under 326,000, and that you would double space down in the remarks, put some maybe double asterisks and say, you could possibly buy this home, because you don't know their credit score. You could possibly buy this home for as little as 1% of the purchase price by qualifying for up to $10,000 in down payment assistance. Please contact the listing agent for more details. Buyers get 5, 6, 10 different MLS listings from the agent that's working with them. And they're going through them and they're looking through them and they're looking through them, and all of a sudden yours is the only one that has double asterisks and says, you could buy this home for as little as 1% of the purchase price. It might get more attention. Just thought I'd bring it to your attention. So what can I do to grow my business? How about a Facebook post with a landing page? How about buy a home for only 1% of the purchase price? Amazing. A $200,000 home could be purchased for as little as $2,000 for existing homeowners and first-time home buyers. For existing and first-time home buyers. Are you waiting to purchase because you do not have enough in savings? Would you like to know how to purchase your next home for only 1% of the purchase price? Find out how you can become a homeowner with this amazing program. Click this link. Here's your landing page. And find out how you can qualify for this. Here's the landing page. Facebook landing page. Again, this is in your agent marketing account. In my other classes, you guys have all heard me say, go to https://gmarino.valuedlender.com. I teach you guys how to create these landing pages, or you just contact me if you need help. But again, this says, hey, congratulations, you're on your way toward home ownership. Find out if you qualify for up to $10,000 in down payment assistance. Buy a home for as little as 1% of the purchase price. It's easy to get started. Give me your name, email, and your phone number, and click submit. And when they hit submit, the realtor gets an email and a text message saying that whoever did John Smith is looking for guidance, wants to find out more about how he can qualify for up to $10,000 in down payment assistance. Same landing page that you're going to use in your Facebook ads, sending people to that landing page saying, if you'd like to learn more about how you can become a homeowner, you might be able to buy a home for less than your first month's rent and your security deposit, click this link. When they do, you're going to get an email and a text message. All right, well, remember, if we messenger 30 people a day, here's a sample. Don't have to use this, use your own way of putting it. But hi, this is Laura Falk with HomeSmart Realty. We're friends in Facebook, so I thought I would share some exciting news. You can buy a home for only 1% of the purchase price. Amazing. A $300,000 home could be purchased for as little as $3,000. Find out how. Call me and let's have a 2-minute discussion on how you, your son or daughter, brother, sister, or friend might just qualify. And you could add it to your remarks in the MLS. Double asterisks, you might be able to purchase this home for as low as 1% of the purchase price. Contact the listing agent and see if you qualify for up to $10,000 in down payment and closing cost assistance. My team will help to see if you qualify. What do they need? 2 green lights, 640 or better credit score, and make less than $109,200. But this might just get your listing a few more looks. With that, I'm going to say thank you and open it up for any type of questions.